Let's look at another paradox called Paranda paradox. This is one of my favorite ones, and it's an example where you have two losing bets, and when you combine them, when you play sometimes one bet, sometimes another bet, it actually leads to a winning strategy. So the first losing strategy is just Bernoulli market. So you gain F with probability 51%, and let's say F equals to 5%, and then you lose F, you lose 5% with probability 49%. And if you plug in those numbers to your logarithmic utility function or entropy function, you actually get a negative utility out of that. So that's a losing strategy according to this utility. And let's consider another game. And this game has a somewhat complicated design. And of course, it's artificially designed. So that's how we can have this strange result. But anyhow, so the design of the second game is the following. When your capital is multiple of some number m, so when your wealth mod m equals 0, so wealth is just a multiple of some number m, then you play a Bernoulli game with probability of winning 1/10 minus epsilon. And if not, then again you play Bernoulli game. If it's not equal to 0, then you play Bernoulli game with probability of winning to be equal 3/4 minus epsilon. And you can show actually that when m equals to 3 and epsilon equals to 0.005, then game B is almost surely a losing strategy. So this game is losing. Okay. However, you can design a strategy where you switch from one game. So we're going to call this game A, and we're going to call this game B. You switch from game A to game B, and you decide when to switch from game A to game B. And you can design such a strategy of switching at the correct time so that when you play those games together, so this green line is this A plus B, so you're allowed to switch from game A to game B. And then you have the blue line, this is line if you only play game A, and then the red line if you play only game B. And you see that the both A line and B line eventually go to 0, but A plus B line actually goes above the starting point of $1. So you start at $1, both of them will end up at 0, and this one actually will end up above $1. So you actually gain here. And both A and B, you basically go to ruins, you lose the entire wealth. Okay. And the proof of this result is quite peculiar. It's not straightforward. It involves some heavy computing, and but you can do simulations. You can just run Monte Carlo simulation of this game and see the results yourself through the simulations. And of course, you can use the Kelly criterion to find optimal allocation of your wealth to game A and game B. And looks like in this case, it's roughly 50-50. So the optimal allocation is 50-50 to both game A and game B. Okay, Breiman-Kelly-Merton rule. So Kelly rule of allocation tells you how much you should be putting on the gamble. However, this rule does not account for the equilibrium conditions on the market. Now let's look at the extension of the Kelly criterion. It's called Breiman-Kelly-Merton criterion. You remember the Kelly criterion applies to Bernoulli games, to binary games, when you win with probability P, that's probability of win. and O is the odds offered by the market. And then Merton rule is just extension of this when you play a continuous game, and in a continuous game you have this number mu, which is your expected return. Economists use word excess for this. And sigma is the volatility. So that's the standard deviation of the return, and sigma squared is just the variance. So you're looking at this ratio mu to sigma squared. So in other words, it's just a signal to noise ratio, the size of the return divided by the size of the volatility on the market. And then you multiply it by 1 minus 1 divided by omega divided by gamma, where gamma is the risk aversion factor. So if you so when your gamma equals to 1, your betting size should be mu divided by sigma squared. And when gamma equals to 2, then you should be betting only half this amount. So the larger the gamma, the more risk averse you are. And then again, omega star is the optimal betting size, and then you have two probabilities here. P is the probability that market goes up, and Q probability market goes down, and O is the odds offered by the market. So this applies to the Kelly criterion calculations. Okay, so let's apply this Kelly criterion to S&P 500, and again we're gonna consider the logarithmic utility case when gamma equals to 1. And we assume that returns on the stock market are identically distributed, and they are independent, which is not the correct assumption. Of course, there's some dependency from one day to another. They're trends, but we assume there is no temporal dependence in the returns, and returns on the stock market follow log normal distribution. And we have annualized expected excess of 5.7%, meaning that on average market returns 5.7%, and the volatility of 16%, which is consistent with long-run equity returns. And we're basically talking about S&P 500 returns. And in our continuous time formulation, so we can say if omega equals to 1, if gamma equals to 1, we get omega star. The optimal betting size is, so this is excess return divided by the volatility squared, 2.22. Basically, the Kelly criterion tells us that you should be borrowing, so you should take all your money, and then you should borrow another 120% of what you have and put this into the stock market. And one also sees that the allocation is highly sensitive to estimation error in this parameter mu. We consider dynamic learning in the later section and show how the long horizon and learning effects can affect the allocation strategy today. So fractional Kelly, the fractional Kelly leads to more realistic allocation. Suppose that we have gamma equals to 3. So your risk aversion is 3. So 3 times the assumption we used in the previous slide. Then, of course, you take this to 20% and divide it by 3. You get roughly 75%, which means that the investor with this risk profile, gamma equals to 3, should be putting 72% of money into the stock market, and the rest should be going to some less risky assets like bonds. And this analysis, of course, ignores the equilibrium implications, meaning that if everybody starts applying the Kelly rule and start betting according to that rule, then the equilibrium on the market will change, meaning that the conditions of the market will change, and the returns will change, and the mu itself will change. So you have this chicken and egg problem. Everybody makes an assumption about how to calculate the betting size, and they assume some value of mu. So they make a bet size according to this mu, and then they put their bets, and the mu changes. and then mu changes, then they have to readjust their bets again. Everybody readjusts the bets, assuming the new mu, and then the mu changes again. So, and at some point, of course, this whole process goes to equilibrium, where basically there is no need to change the allocations anymore. There is a balance between mu and omega squared, and we're going to talk about this balance situation. But meanwhile, let's talk about the 60-40 rule. You often hear this 60-40 rule, that you should be putting 60% of your money into the stock market and 40% into the bonds. And now let's look at another example. If we want to split our money between two investments, and we consider SPY, which is the ETF that follows S&P 500, that ETF that follows S&P 500 index, and TLT, which is the treasury bonds. So this is considered, TLT considered to be safe and predictable. S&P is basically average stock market. And what you want to know, if you want to split your money between market and bonds, or stocks and bonds, what should be the split? And what you see here on the left plot is the fraction of S&P in the portfolio. So, and this is on the x-axis, and on the y-axis you have the return. And this is over the period from 2005 till 2019, I believe. So this is a 14-year period. And this is looking backwards. So if this was the split during this period, that would be your return on this portfolio. So if you have no money in S&P 500, you roughly double your money. If you have all of your money in S&P 500, your returns are slightly higher. So it's roughly 2.2 to 120% return over this period. However, you can get a larger return if you split money between S&P 500 and TLT. And this is somewhat counterintuitive, because you have two investment vehicles. One gives you the higher return, another gives you lower return. And if you actually split between those two strategies, you can increase your return. And the optimal allocation seems to be at around 60%. So that's the peak. So you have 60% in S&P and 40% in TLT. And you might have heard this rule before, this 60-40 rule, that you want to split your investments 60% in stock and 40% in the bonds to maximize your returns. And this is the average one across all possible scenarios. And also in this plot, we consider scenarios where your fraction goes beyond 1, meaning that at this point we put 150% of the money, so we borrow money, and we put this into S&P 500, and we short 50% TLT. So short TLT, 150% S&P, which doesn't seem to be that good of a strategy. And of course, this is static in this case, so we'll look for the long period of time, but in reality, what you would do, you would run it in the Bayesian way, meaning that once in a while you want to update this allocation percentage. You want to look at the current market conditions and recent past, and you want to weight recent past a little bit heavier than you weight things from far in the past. And you can apply the Bayes rule to update the portfolio weights and do this Bayesian learning of the portfolio allocations. And on the right plot, you see the daily returns for the S&P 500 and TLT. This is actually cumulative returns over this period of time. And again, as you see that TLT is actually, it's hard to say. It's almost the same, and you can see on this plot the TLT and S&P returns almost the same, because we had this 2000. I think this is 2000 9 crash and in S&P 500, and it took a while for it to recover. Okay, and we're gonna consider another scenario. What if you want to allocate money between TLT, or the base rate, and the Keynes portfolio? Keynes was an economist. He was famous for his work in economics, but he also was famous for managing university fund. I think it was Oxford University or Cambridge University. He was managing the endowment, and he applied relatively aggressive investment strategy. He traded, and he traded aggressively. And what you see on the right hand side is performance of the riskless portfolio. This is the red line. So this is portfolio with no risk, so equivalent of TLT on the previous slide. And the green one is the universal. So this is market, and the blue line is Keynes. And you see how aggressive Keynes and how successful actually Keynes behaves according to those universal metric and the riskless metric. And now if you want to decide how much money you want to put into the no risk investment versus Keynes, and you apply the same strategy, you look at the different allocation ratios, and it actually happens to be the case that you want a little bit more than 100% of your money, so roughly 120%. So roughly 120% of your money you want to put into the Keynes portfolio, and the rest of it means you want to short the riskless vehicle 20%. So yeah, so allocation ratio depends on the performance of the portfolio, and this portfolio Keynes, although it's very volatile, but it's also very profitable. So you want to leverage money to put into this portfolio. Now we're gonna look at another example, the Black-Litterman example. We talked about this continuous generalization of a Kelly rule, that your optimal allocation omega star is 1 over gamma. Gamma is your risk level, and then mu over sigma. But now in this case, we're not going to look at a single investment. We're going to look at investing into portfolio. So now mu is going to be expected return of each of the elements of this portfolio. Now in this case, it's a vector. So if we have a portfolio with n positions, then mu is the vector of size n, and sigma is the covariance matrix of the returns. It's a square symmetric matrix, positive definite of size n by n. And sigma inverse is the precision matrix, and optimal allocation inside the portfolio is, again, 1 over gamma sigma inverse times mu. And the question is how to specify this pair mu and sigma. And we talked about this phenomena that there is a chicken and egg problem. If everybody starts allocating their portfolios according to this optimal Kelly criterion, then they, by doing that, implicitly will change the return and the covariance matrix sigma. And if they change, then they have to go back and change. So omega square, omega star will affect mu, and mu will affect omega star. And at some point, if you imagine this as a pendulum type of system, so you allocate, you invest, mu changes, and then you update your omega star, then it affects mu, it changes, then you update omega star again. At some point, those things will reach equilibrium. And now the question is, given that the system reaches the equilibrium, how should we allocate our money to the positions in our portfolio? And Black-Litterman studied this question. They did it in the early 90s, and they came out with a Bayesian view, Bayesian way of updating the mu. So, for example, given that we know sigma hat, given what we know the covariance, Black-Litterman derived Bayesian inference for mu, given market equilibrium model and a prior view on the return of pre-specified portfolios. And their formulas are of this form, so they just use normal priors, and so as a result they get normal posteriors. We'll talk about conjugate priors a little bit later in the course. And here is the posterior view. So posterior mu, given the initial assumption about mu hat, is also normal with parameterized by three values, capital B, small b, actually by two values. And we can calculate capital B and the small b from the quantities that are known to us, these posterior moments, and then we can define optimal allocation rule, assuming that equilibrium is reached on the market. The math behind this is actually not that complicated, and you can go back and read Black and Litterman papers. They are relatively straightforward, and derivations straightforward. So they just use the properties of normal distributions to derive those posteriors. We're not going to do it in this class, but I just wanted to give you an example of how the Bayesian updates can be used to solve rather sophisticated market equilibrium problems and investment allocation problems. Let's look at another example, Super Bowl. Ravens versus 49ers. And what you see here are the scores for each part of the game. And then you see the plot of Ravens' chance of winning. So you see at the beginning of the game, Ravens had roughly 35% chance of winning. And in fact, Ravens did win the game. So at the end of the game, it was 100%. So, and you see as Ravens scored, so this score was 7-0, the chances went up. And then Ravens scored again, 14-3, so chances went up again. And then they scored again, chances went up again. And then they scored again, 28, and looks like that was the peak, 28 to 6, and the chances were close to 100% here. And then you have this blackout period when this graph was not updated, and it pretty much stayed the same until the 49ers scored, and then 49ers had a field goal, so the chances went down again, and then the Ravens scored here again, and the chances went up again. And then the chances went down significantly when 49ers scored their first goal, and it was in the fourth quarter, right before the end of the game. So looks like people started hoping that 49ers can come back in the fourth quarter and actually win the game, and they updated the probability back to 30%. But no, right before the end of the game, actually, yes. So the 49ers never scored again, and the game ended with 34-31. Okay, so let's keep this in mind and do some Bayesian analysis. So this is some information about the Super Bowl. It's 2013 Super Bowl, happened in New Orleans. And we're going to track this X of t, which corresponds to Ravens' lead over the 49ers at each point in time. And this table below provides the score at the end of each of the quarters. So at the beginning of the game, they started with 0-0, and then 7-3 at the end of the first quarter, and Ravens led by 4, 21-6 at the halftime, and Ravens were leading by 15, 28-23. So the lead actually narrowed to only 5 points, and at the end of the game it was 34-31. So it was even more narrow, 3 scores at the end of the game. And initial point spread, Ravens begin a 4-point underdog, meaning that the book is predicted that Ravens will win by 4 points. So they estimated that X1, the spread, the difference in the scores at the end of the game, expected value of it is -4. That's our value mu. Mu is the expected value of the spread at the end of the game. And in fact, Ravens upset 49ers by 34 minus 31. So they upset by 3. So this is the actually observed value. So that was our expected value. And that is our observed value, which means that they were 7 points away from what book is predicted. And now what we want to determine a market's assessment of the probability that Ravens would win at the beginning of the game. And we use the money line odds. So San Francisco was -175 and Baltimore Ravens was +155. This implies that if you place a bet of $175 on San Francisco, you win $100 back. And if you bet $100 on Ravens, you would win $155 back. Now we can convert both of these money lines to implied probabilities of winning. Probability of San Francisco winning is 175 divided by 100 plus 175, so 68%. And probability of Baltimore Ravens winning is 100 divided by 100 plus 155 is 0.39, roughly 0.4. And as you see, they do not sum up to 100. And actually, if you sum them up, you get this 7.8% excess probability. And this is the edge for the bookmakers. So you can think of it as the fee that bookmakers collect from the bettors. You can put it differently. If bettors place money proportionally across both teams, then the bookies will make 7.8% on the total amount. So it's not a good strategy just to go and beat on both of the teams, because at the end you just paying 7.8% fee to the bookie. We're gonna use the midpoint of the spread to determine P, implying that 1/2 probability that Baltimore wins times 1/2 that 1 minus probability San Francisco wins is 0.3. From the Ravens perspective, we have probability that X1 is greater than 0 is 0.35. So probability that Ravens win is 0.35. So 35% chance that Ravens win. And I'm not sure why I have 38 here, so it's 35%. Okay. Let's do halftime analysis. You remember that at the halftime it was 21-6. So if you calculate the probability that Ravens win at the halftime, it was 90%. So it went from 30 what we calculated 35% at the beginning of the game to 90% at halftime. Okay, so that's at the beginning. So let's look at the plot that was plotted here, and let's see whether yeah. So it was roughly 35% here, and then halftime, end of the second quarter, we are here. So yeah, we are at around 80%, 82%, and we actually calculated 90%. During the 34-minute blackout, there were 42,000 contracts that changed hands, and Baltimore win probability ticked down from 95 to 94. The win probability peaked at 95%, and it occurred after a third quarter kickoff return for a touchdown. At the end of the fourth quarter, however, when 49ers nearly went into the lead with a touchdown, Baltimore's win probability had dropped to 30%. So that's this huge drop on the plot that we're talking about. Okay, so that's when 49ers scored their first goal. All right. So now what we want to do, we want to calculate what is called implied volatility. Implied volatility, here is what it means. So you assume some probabilistic model of the quantity you want to explore. So in this case, we explore the spread, our value x of t. So that's our random quantity. And we assume it follows some distribution. And in this case, we assume it follows normal distribution. And we say it's mu of t and sigma of t. So in different times, it will be different. And in this case now, we know both the probability of observing certain value of xt, and we know mu of t. Remember, we will have our implied mean. And we can actually reverse engineer and calculate the variance parameter. And we're going to start by looking at the beginning of the game when the expected lead was -4, so the Ravens expected to lose by 4, and the expected probability of win was 35%, and the implied volatility is just mu divided by inverse of the cumulative distribution function. This is normal CDF, evaluated as this value 3.53. And if you calculate this one, this is actually negative 0.377. If you plug in everything together, you get this 10.6 value. Which means that at the beginning of the match, you have -4 plus minus, so the 95% confidence interval, you remember it's 1.96 times 10 times 60. So that's a 95% confidence interval for the outcome of this game. And you remember that they actually lost the 4-point average assessed for 49ers is actually under half of the standard deviation, under half of this volatility value. And the outcome, the spread was 3, the outcome was within 1 standard deviation of the pregame model, which had an expectation of -4 and volatility of 10.6. So the model actually, the prediction wasn't that bad, although the outcome did not agree with the prediction, but still the outcome was within 1 standard deviation of the predicted score at the end of the game, predicted spread. Now let's do halftime probabilities. We want to calculate the probability that Ravens win given their lead in the halftime. So we want to do the update. You remember we started with mu equal to -4, and probability of Ravens winning was 0.35. And that was at the beginning of the game, t was 0, and now we're at the half of the game, t1 half. So we want to update those values. And you remember at the halftime, the new piece of information that we're going to use to update the probabilities is that the Baltimore Ravens had a lead of 15 points. The score was 21-6. So we want to use this information that they are 50-point lead now to update the probabilities of them winning. And we're not going to go through details, but we're actually using this normal hierarchical model here, and we can update the mean, and the mean is just our new value plus 0.5 times -4, which gives us 13. So that's our new mu for halftime. And the conditional volatility, actually, we assume it decays, and it decays at square root t rate. So the new volatility is just the previous volatility, 10.6, 1 minus t square root. So it's basically 10.6 times 1/4. Okay. And now if you calculate probability of them winning at this point, it comes to around P of Ravens winning comes to 0.9 96%, and this is roughly the number that we saw on the plot, which was the implied probability from the betting people made. Okay, a second estimate of the probability of winning given the halftime lead can be obtained directly from the betting market. From the online betting market, we also have traded contracts on this tradesports.com that yield a halftime probability of 90%. So looks like market had a somewhat inefficient estimate of the winning probability. Our model predicts 96% chance of winning, and the market thought it was 90% chance of winning. So it looks like market was a little bit slower to update probabilities, not fast enough catching up. So the moment you see this type of a lead, you should update to 96% probability rather than 90% as market assumed. And let's do the same calculation for the implied probability on the second half. So we have our mu, our new mu is 13, and our then we apply phi minus 1 to the 0.9, the probability of winning, and divide by the square root of 2, which is so 1 minus 1 half, and we have the square root, so it's just square root of 1 half, so it's just divide by square root of 1 half, which gives us 14. And again, so the volatility is 14 versus 10.6. Volatility went up, so the things become a little bit less predictable. The market was expecting a more volatile second half, possibly anticipating a comeback from 49ers. So that's why this 0.9 tells us that people still, although objectively you should be very confident or somewhat confident that Ravens will win at this point, market still was saying 0.9 because they just assumed that the game will be volatile, and this volatility will lead to Ravens losing the game. Now we want to formulate optimal betting strategy. So we're in this situation where probability that we win our bet, so if we bet on Ravens winning the game, so again we have this Bernoulli game, probability of win is 0.96, and the market odds are 0.9. So the market tells us that we will pay you according to the 0.9 odds, and you know that the probability of winning is 0.96. So you know the odds in your favor, and you actually should bet. But what size of the bet you should place, given this market odds and given this probability of the win, we can again use the Kelly rule for this. Probability of you winning, so 0.96, minus the probability of losing according to the market odds divided by the market odds, so 10% of losing according to the market, and the market odds are 1 to 9, so 0.6. You should take 60% of the money that you're willing to bet and bet in this scenario.